Yes, sure. So we'll start with this chapter number 4. So in the previous session, we had a recap of what we had seen in the intermediate. Okay, so essay 315, 320 and 330. So now let us go through and see the Q&As also, and let us understand how they are going to ask certain questions in the exam, how this study material has been organized. Okay, if I have to take you through the broad concepts of this, if I have to break this subject, because in every chapter we are breaking into concepts. So if my chapter number 4, if I have to break, I can classify into 3 broad categories. Concept number 1, risk assessment. Concept number 2, risk based audit. And concept number 3 is the internal controls. This is the broad. Okay. Now in internal control, we have got so many sub concepts like understanding of the internal controls, a traditional structure of internal control, COSO structure, then communication of significant deficiency, evaluation. Risk-based approach has got sub-concepts. Risk assessment has got sub-concepts. So we will understand. But at the very outset, you need to understand that this particular chapter has got 3 broad concepts. So always we go through that way. We try to break the entire chapter into small sub-concepts, and we will master that one by one. Okay. So we'll go through now. We'll see what does it says. So they say that understanding of the concept of risk-based audit, internal control and risk assessment, identifying the components of the risk, internal controls, nature, scope, okay, general framework, etc. Okay. Now, CAY is an auditor of a company. He sets to assess the audit risk for the engagement, and one question comes to his mind: does this exercise useful for him practically? Okay, or is it just a theory that we have to assess the audit risk and all? So he seemed to be caught in Sally approach. Sally approach means same like last year. This is everybody gets caught. Okay, same approach of last year, same approach of, oh, this is what I got in last 8 years also. Every time I teach the same way what I have taught in the last way. It's got the same as last year. Now we have to change. Now he knows that assessing of the audit risk has become mandatory under SA 315 and 30. It leads to the audit to be more effective and helps to plan the audit in a better way. Now for this, to do the assessment, you need to understand the company, its internal control, identify the areas where there are errors and frauds. The risk assessment need not be the same, because what he has done last year, it can be different due to some developments. And one very important thing, he understood how the business risk is going to influence the audit risk. Always we discussed once. Business risk and audit risk are 2 sides of the same coin. Business risk talks about the rupee, audit risk talks about the accounting. Now they understood that every audit risk has been influenced by the business risk. So company need to plan and deal with the business risk peculiar to it. So because of this, no auditor gains the comfort. So if the company is going to address this, automatically this should get addressed, because every accounting risk comes from the business risk only. Now evaluation of the internal control, that's why understanding of the control becomes very necessary. It helps to figure out the controls where they are deficient, and if you feel that the controls are deficient, you should shift yourself to substantive procedures. Now the ROMM increases because of the increase in the control risk. So you are going to perform risk assessment procedures. See students, we discussed in the earlier session also. Risk assessment process, risk assessment procedure. Who is doing risk assessment procedure? The auditor, like inquiry, inspection, etc. helps to identify the risk so that it can be assessed. Now significant deficiencies can be found out, and he has got a responsibility to communicate such deficiency to the TCWG. It helps to save the auditor's skin and could come as a defense to the auditor later. That means whenever you come across significant risk, you may have to communicate. Okay. The first part of the section, which is talking about risk assessment, because we cannot talk about risk assessment independently without talking about the level of materiality. Because if I have to tell what is risk, I should be aware like what is the level of materiality set by the institute. Like tomorrow, if the institute says no, 50% aggregate is not okay, we have to secure 80% aggregate. Then that means the materiality level, they have increased now. Level has been changed. Above it becomes important, below it is unimportant. So your efforts are going to be changing accordingly. Now essay 620 talks about the concept of materiality. So when we talk about a materiality, there are three types of materiality. Overall materiality, which talks about the accounting from point of view. Specific materiality, if anybody investors focus is on some of the item. Performance materiality, which essay 320 talks about, so that auditor has to verify every item. So materiality has to be applied at the planning and performing and evaluating the effects of the misstatements. Now, materiality and audit risk are considered throughout the audit in identifying and assessing the risk of misstatement and defining the further audit procedures, whether should I do test of controls or substantive procedures, and evaluating of the uncorrected misstatements. That's it. This is what they have spoken about materiality in this particular chapter. Again, you are not going to find anything. Now, you may be thinking that, okay, they did not talk anything about essay 320, only inter they spoke. And they only told, what is that they told? That we are not going to ask any descriptive questions, but we will ask you only MCQ questions based on this. Okay, let us go back and see some of the test your knowledge question or MTP question which has been asked in the new syllabus. And you will be surprised, friends, the entire question is related to your intermediate. Means the concepts have not been discussed. So the moment any descriptive question becomes part of your syllabus, it can come for exam. Please understand. So first we will go to the question MTP September 24, which by mistake I had plotted in chapter number 2. You remember, no? I told we will discuss in the next chapter. So this particular question should have come in this particular chapter. So it is a question number 58. Question number 8 in page number 58. So let me go back to page number 58. See, this question came in your Test Your Knowledge 9. Of May 25 study material. Okay, you have been appointed as an auditor of a multiplex cinema house. Oh, sorry, not this, audit execution. This question came in your Test Your Knowledge 14, and in MTP of September 24 and April 25, this question came. Yashu, chartered accountants have come across in the course of audit of a company that certain machinery has been imported for production of new product. Okay. Although the auditors have applied the concept of materiality for the financial statement as a whole, which materiality they are talking? They are talking about the financial statement audit, okay, or the overall financial statement. They now want to re-evaluate the materiality concept for the transactions involving foreign exchange. That means, are they need to separately evaluate, they need to revise that now, because previously they were not aware that they are going to import one new production of a new product. See, the moment a new product comes into picture, everybody's attention will go towards it. Like for example, you enroll into CA, every relative's attention will go to you. Oh, that they have done. You start one new shop. Anything you do something new, no, everybody's attention will come. Now they are observing you very more closely what you are going to do. See, if you are not doing it, nobody will care. But the moment you start doing something new, everybody start observing. So now you tell me, friends, should you not re-evaluate the integrity? Give your views. Are you supposed to re-evaluate? Okay. Auditor applied the concept of materiality on the basis of obtaining additional information about the contractual arrangement that draw particular aspects of the company business. You want to re-evaluate the materiality. Please guide him. If I go back to essay 330, see, essay 330 has got two elements. First, fixing of the materiality and a revising of the materiality. Now let me take to you to the revision, because they are talking about should I re-evaluate. Yes, auditor shall re-evaluate the materiality for the financial statement of a whole when you come to know about certain circumstances like new acquisitions, labor unrest, introduction of new product, regulatory requirement. And you see, the one of the reason you have to re-evaluate is introduction of a new product. It's just an example of circumstance. That's why you are going to say, yes, in the given case, the materiality has to be re-evaluated. So I have marked, okay, so you can mark this question as a priority 1 question, friends. I have missed it. The reason I told you, in the study material there is no answer. Only in the MTP and test your knowledge only you have got this answer. Now you say that auditor has to determine the financial statement as a whole. there is one or more particular class of transaction. This is what materiality they are talking, overall materiality. Then auditor can, in a specific circumstances, you can fix the materiality for a particular class of transaction, account balance or disclosure. So the given case is not related to that. Okay, if I take back you to this is that they are talking specific materiality. They can fix materiality only for one particular item because of the industry disclosures. Like in pharma company, certain disclosures they have to make, or I told you new acquisition of the business could have happened. In such cases, you can fix it. The auditor shall revise the materiality. This is the main answer you have to write. What are the examples? They told you some of the example. Yes, so in the given case, since you have introducing new product, you may have to draw the attention of the users to the particular business. So you have to revisit it. I hope it's clear, students. Your mark it as important. Chalo. Now let us go to the other questions of essay 320. Yes, we have completed this. Let us go to test your knowledge 1 question of this chapter. Compute. Wait. Sorry, test your knowledge 1. Na? This is 7 of question number 7. Yeah, only one up and down has happened, friends. I may have to change. You can also change it later. So I'll go to question number 7. Yeah, actually this should have been question number 2 because that should be my question number 1. So this question also came in test your knowledge. B was appointed as the auditor of SRT Limited. During the course of planning, he wants to apply the concept of materiality to the financial statement as a whole. See the key word here, materiality to the financial statement as a whole. Guide him with respect to the factors that can affect identification of the appropriate benchmark. Very clear, because if you go now, they are talking about the first requirement, determining the overall materiality and performance materiality. And how to do? You need to take a benchmark. We discussed, no? 600 mark is your benchmark. Then you have to multiply it with 1%. So these are all the examples of the benchmark. And what is the factor you consider to identify the benchmark? These are all the factors. So what they are asking you in the examination in this question, guide him to the factors that can affect the identification of the benchmark. Okay, this is question number 1. First thing, have you identified the chapter? Yes, chapter number 4. Have you understood the requirement concept number? Yes, this is the first concept. Under risk assessment, it's going to come. Then under that, which requirement? The requirement number 1, where you are talking about the identification or determination of the materiality. Then, how many issues are there? How many questions are there? This is the first question. Second, what benchmark should be adopted if the company, if the client is engaged in the manufacture and sale of air conditioner having regular profits, then you can take total profits. See, if I go here, I can take gross profits because you have our profit before tax. Second, the construction of large infrastructure projects. See, in case of infrastructure project, no, you may not have a regular profit and incurred losses also on top of it in the financial year due to pandemic. Then you can go with the other basis, like for example, total asset value, net value. So you can choose accordingly. Yes. So X was appointed as an auditor. What all the factors affect identification? Chalo. So you will say that elements which is affected. Okay, so attention of the users, nature of the entity, relative volatility. So these are all the factors will affect. So since you are in the manufacture of air conditioner having regular profit, you can consider profit before tax. If you are into the construction of the air infrastructure project, you can consider revenue or gross profits. Alternatively, okay, if you don't want to write this, auditor may consider criteria relevant for audit using utility programs or projects like total cost, net cost, okay, government, like the grants, total grants received. So many things are there. Where the entity has custody of assets, you can say asset value. So it depends upon that. Like suppose you are the auditor of a warehouse. Now what is the benchmark for you? Warehouse is concerned with the custody of somebody's assets. So you can just say, because that is the only business they have got. They have to take care of the custody. What is the total value of the total assets which you have stored? Multiplied by 10%. Something like benchmark you can fix. I hope you are clear, students. This part of the question. Yes, so we are done with the test your knowledge 1. Then MTP March 26 and test your knowledge 13. So where is this MTP March 26? Yes, here. I marked it also as a priority question. Ananya has been appointed as a statutory auditor. It has got to operates in two business segments. Home appliances division that manufactures washing machine, infrastructure division, highway, public utility, etc. They want to determine the materiality for the financial statement as a whole. Chapter number 4, concept number 1, sub-concept number 1. She seeks the guidance of the factors affecting the identification and benchmark that can be applied to the division. Appropriate benchmark. Okay, so now you can say home appliances, profit before tax, same question. And the last question here will be test your knowledge 13. While assessing the impact of uncorrected misstatements in the audit of Manhattan constructions. That means uncorrected misstatements means let's say 450 comes to your mind. Sushil encountered significant issue related to the calculation of materiality on sales. This is the keyword. The initial materiality calculation was based on the estimated figures provided by the management, obviously, because when you start, you don't know, you might have taken sales. You tell me, students, when you fix materiality during audit strategy time, you go back again, chapter number 2. Strategy time, you have got the materiality concept. Which materiality they are talking? Overall materiality. When you fix the overall materiality, you need a benchmark, so you will take sales. You tell me, Arey Baba, you are at the beginning of the year. How much is the sales for the entire year? How do you know? So what you must have taken? You must have taken last year's sales multiplied with the 10%, say for example. So, or you must have taken budgeted sales and multiplied with 10%. Whatever. Now, when you got a clarity about the actual sales, it is only at the end of the year. That's why when you are evaluating uncorrected misstatements, let's say 450 says, you may have to revisit the materiality because your original materiality was based on the last year figures or estimated figures. Now you have got actual figures. Now again you calculate the materiality. The initial materiality was based on the estimated. Notably, during estimation of the full year sale, management extrapolated from the actual amount of 11 months to derive 12 months of the sales. However, the nature of the construction company sector, monthly sale exhibits substantial variation. So unique challenges are going to emerge. Okay, so you cannot extrapolate. Like 11 year I made sales like this and 12th month I will make sales like this. In construction business, not possible. So the actual sales of the last month deviated significantly from the estimated sales for an unforeseen increase in the stamp duty rates imposed by the government. As a result, last month's actual sales represented only 25% of the estimate. That is, the very big jump has come now. Sushil is confronted with the dilemma. Actually, I don't know what is the dilemma for them. They have to revise the materiality. Why that person is dilemma? Regarding appropriate approach to evaluate the uncorrected misstatements. Okay, so this is, I can say, 450 question. Previously calculated materiality, kindly guide with the relevant standards on auditing. So first thing you are going to talk about 450 because they are talking about the evaluation of uncorrected misstatements. Okay, students. So again, you can mark it as a priority question because these things are not seen in your study material. This is purely your inter question. Now they have included in your MTP and that to all see May 24, October 24, April 26. So first you need to understand what is SA 450 says. It says that you have to reassess the materiality and check based on the actual figures. Now 320 says materiality has to be revised if you become aware about information which is different from the initial. Okay, now you came to know that the sales is 25% different. Yes, you may have to reevaluate. Or typically significant revisions occurs because evaluation of the uncorrected mistakes. So I can apply this particular point also. However, assessment of materiality, auditor must consider the performance materiality and appropriateness of the audit procedure. So the moment your overall materiality will change, your performance materiality also change. If suppose tomorrow, if ICA says out of 600 you need to score 400, do you think students per subject 40 only they will keep? They may change it to 50, right? Similarly, when your overall materiality is going to change, you have to reconsider the performance materiality also. That 40 is more like a performance materiality. This is crucial for obtaining sufficient appropriate evidence based on which the opinion to be based. Okay, story they have told. Auditor must review and reassess the materiality and in this process reconsider the performance materiality also. Okay, so this is the point. You have to revisit the materiality at the financial statement as a whole. Okay, so this point also they have not given. These are the examples. And these are all the factors you need to consider in revision of the materiality. Materiality to be revised for a specific class of transaction if it is because of you are aware of something new. Yeah, so that's why I told you please mark it as important. Yes. So did you see some of the question without even being discussed in the Q&A in the study material? So they have given you. Yes, so let us identify. Let us be happy because we found some gem, because these questions can come for your exam. Okay, so I hope you are going to revise it. Okay, so all the question, see, all these questions should be together. Chapter number 2, test your knowledge 1. Anyhow, I have shared this material. You can make it a mark. Yes. So now we will move on. One very interesting and very nice concept we need to understand called the risk assessment. Now, what do you mean by assessment? Like we say, no, class assessments. Assessment means measurement. What exactly you are measuring? You are measuring a level. What is level? Level means position. We say, no, he has reached that level from here. What is position? A place, a location, where exactly you are. Are you in the same place or have you changed your place? Where are you now? Where is the risk round? Is it at an overall level or is it at an assertion level? So I hope it's clear, students. So when you talk about the concept of a risk assessment, you are trying to assess or measure the level of the risk. Where exactly the risk is located. So what I am trying to do, I am also trying to figure out the same. Where is that risk? Do you lack memory? Do you lack articulation? Do you lack the time management? Do you lack application? And for this note, there are different types of tests has to be performed. That's why generally a mock test, no, includes all the 4 elements. Memory also it is included. Your application is also there. Time management is also there. Articulation is also there. That's why this is considered traditionally the best testing method, right, in mock tests. Otherwise, no, see, I can bring an MCQ into picture. What MCQ will do? MCQ will test only your applications. I can give you homework every day. What you are doing? Articulation. Okay, so risk assessment means identifying the level of risk. But problem what happens, no, student, when we give one single test, it becomes very difficult to figure out. Suppose out of say 50, you scored 30. Where did you lose that 20 mark? Did you lose it because of memory, because of your writing skills, because of your time management? This becomes very difficult. That's why traditional method of testing may not help us to measure the risk accurately. Similarly, what you have been doing audit previously, that's a different style of audit. Leave it. Today we are going to do a new concept called a risk-based audit, where you start doing assessment of the risk and try to figure out that risk and develop your response. So risk assessment focuses on the business environment, regulatory and organization structures. So what all the areas required need to be understood and you need to understand. First, you need to understand external factors. Okay, I will take back you to essay 315. What is that you need to understand? You need to understand the external factors, which includes your industry and regulators. Please understand, students, the difference between industry. This is your entity. Like this, there are similar competitors. All the competitors together is called industry. Now, banking is a different industry. Your software is a different industry. That's why we talk about, when we talk about the industry factors, we talk about the market. Because what is market? Group of customers is called a market. Now, all the competitors are keeping eye on the same set of customers. Everybody is subject to that seasonal activity. Everybody is impacted by the product and technology. Supply, cost and all, everybody is impacted. So these are all your industry factors. When you talk about regulatory, yes, your industry specific practices you are supposed to do, like say SEBI has told you, RBI has told certain banks. There are industry specific practices told by the bank. regulatory frameworks, taxations, government policies. So all these two factors becomes external because the entity has got, and demand and supply, interest rates, etc. Because entity has got no control. Are you clear? Then comes understanding of the entity. These are all entity specific factors. Here entity has got absolute control over where to run the business operation, who should be my owner, where I should invest, from where should I get the cash. Entity has got, these are all kinds of internal factors. Then based on this, you consider the accounting practices. How do you do the accounting? And you may have to review the financial performance. So these are all the four aspects: external factors, nature of the entity, entity's objectives and the strategies. Because your objectives decide, no, business risks. You want to get into it, you have got a risk. You don't want to get into it, you don't have a risk. So what is your business risk? Business risk comes from your objective. What is your business objective? Do you want to expand? Do you want to stabilize? And fourth one is to review the measurement review of the financial performance, like how your financial performance are indicated, like what that you are going to show to the people. Like my daughter always tells to me in terms of marks. Okay, just now also she told me, sir, in biology I got so much marks. Okay, I say very good, but I feel like laughing inside. Anyhow, because these are all the measurement of the financial performance. Like everybody has got one criteria, KPI, key performance indicators. So this is what you need to understand. And you need to ask one question: what can go wrong? Because always risk-based audit starts with the question: what could have gone wrong? You identify the risk. Now, identification of the risk. So when you talk about the risk assessment means figuring out the place of the risk. And to figure out or to measure the place of the risk, are we not supposed to first identify what type of risk is there? Okay. Now let us start with the identification of the risk. First, what is risk for an auditor? That risk we call it as an audit risk. Now, what is that risk for an auditor? What an auditor will do? His final product can go for a toss. Like what is the risk for you? The final answer what you are going to write in the examination, it could be wrong. Everybody has got a risk. Now, this wrong opinion could have happened. This is the biggest problem. That means the auditor is appointed to express an opinion there. His very purpose is there to express an opinion because he is highly trustworthy. He is independent. So the risk what auditor faces is related to the wrong opinion. However, wrong opinion can take two forms. Financial statement could be wrong. Auditor says it is correct. Financial statement is correct. Auditor says it is wrong. Now, which is the audit risk here? Both are risk. Both are wrong opinions. But is both are audit risk? Answer is no. This particular instance becomes audit risk. Now, why not this particular instance? Because this is discussed at the inter-level. This is called an auditor's business risk. I can give you another example, students. You go to a doctor, okay? Doctor tests you. You have diabetes, but doctor says you don't have diabetes. Versus, you don't have diabetes, doctor says you have diabetes. Now tell me, which is risk? You say, sir, the first instance. Because it can really impact us. The second thing, no, it is more like an opportunity cost. So when the doctor told you have got a diabetes, I will stop eating sweets. That's it. But the problem, it doesn't have a much, okay, anyhow, it's good only, I don't eat sweets. But if the doctor says you don't have and you trust them and you start eating sweets, it can have side effects. Okay. And again, there is one more reason, students. Why do we consider this? Because always we have to consider when we talk about the concept of risk, there are two dimensions to the risk. Now we will discuss in future. Very beautiful. Huh? In 1921, somebody invented this. What are the two dimensions? It's called a percentage, probability of occurrence and its impact. Now, why only two dimensions? Why not there three dimensions? We will talk. Now, any risk, no, we have to evaluate from the possibility, chances of occurrence. Since both are mutually exclusive, it's not possible that you will have diabetes also, you don't have diabetes also. Okay. So, what is that chances which is very high? we can say 90 to 95% chances we would have been into this situation. The financial statement could have been wrong. Now, this is only 5 to 10%. That means we call this remote. So when something is remote, we can actually ignore it. And again, from the monetary point of view also, this is more impactful. I hope, students, you are very clear. From what anybody asks you, you have to have that dot clarity to answer them. What is an audit risk? It is a wrong opinion. Wrong opinion can have two types. But which wrong opinion you are telling? When the expressing an inappropriate opinion or a wrong opinion, when the financial statements are materially misstated and you said they are not materially misstated. Now, how this audit risk comes into picture? Always remember, everywhere there is one element called the inherent risk. Inherent risk. Now, this is very inherent in everything. Like in the rainy season, you have got inherent risk of getting cold. Why? Because it is raining, you can get wet. Now, can you control that inherent risk? Absolutely not. This is what I always call systemic risk. You don't have a control over it. How much? 50% we can say, or 100% you will give. We will always assume that things can go wrong. Now, audit risk is the, okay, they have given you a picture and they try to explain what is the concept of risk of material misstatement. The inherent risk is something like falling stones or falling rainwater. I will consider, okay, instead of stone, I will consider it as rainwater. Now, any material at all, yes, obviously. Now, what you are going to do, students? So, in the rainy season, you know the chances of inherent risk is very high. It can be highly possible that it can rain at any point of time. So, this inherent risk is going to create one more risk for you. That means if you don't do anything, you end up getting wet and you may have a cold or a fever. So, what is that you do? Can you stop the rain? No. Can you predict the rain? No. The best thing, you take one umbrella. Taking one umbrella is called controls. But is it there that you would have taken umbrella always? No. Sometime you might have forgot. So now what happened? Something high possibility to happen, and that day you didn't take the umbrella. So see, by taking umbrella, what happened? At least a lot of things you prevented. Then what falls? Only one thing falls, or two items fall. Because even though you take the umbrella also, some of the water can fall on your head. Now comes the detection. Now who is this another person? Say, suppose, for example, you are getting wet. You have got a cold. You have got a fever. You have anyhow you are suffering. Who else is suffering along with you? Your parents. Now imagine your parents have figured out one method, students. Like for example, they have got, say, Dabur Chyawanprash. So what they do now, they always give you Dabur Chyawanprash whenever you go out, and assume that the day you have taken Dabur Chyawanprash, even though you don't take umbrella, even though you get wet, nothing happens, because that day your immunity level is very high. There are chances that the parents may not have given you Dabur Chyawanprash one day. And you see, students, what happened now? Because of this, the risk has substantially got reduced. So what you have at the end is only one risk, which is not materially misstatement. Okay, I can give another analogy to this. Later I will explain you with this equation, how mathematically we can speak about it. Somebody, exam is there, not preparing at all. It's an inherent risk. So many bouncers can come on the head. Agree with me? If you are not prepared, straight away you gone to the examination to test your luck. Maybe anything can happen. I don't dispute that due to luck factor also somebody can clear. But the real fun is awaited later. Okay? That is different story. Leave it. That's why don't trust luck. You develop your own competency and capability. Because it is not just you clear the exam, students. Please understand. It's not a matter, because maybe I understand your top priority may be to clear the exam, but there is something else after the exam. So that's why we will not focus on luck. We will focus on our competency. Whatever. Now, Not preparing and going for the exam is more like inherent risk. Now you start preparing, you prepare yourself. This is more like putting controls. With this preparation only, lot of risks are avoided. Then I will come into picture. Who? Me, auditor. I will perform some test. If you are preparing extremely well, it makes no sense for me to test you, no students. Please understand. This is how it works today outside. Because see, faculty is only a tool. Okay, ultimately you are the one who matter. Now, when I have got a large pool of students, then in the probability things will pass. I need not verify you. What I should actually focus upon, I should focus upon where there is a risk. This is the concept of risk-based audit. You don't focus on someone who is preparing well. Not required, because anyhow it will happen. You just give them push and motivation, test or talk from time to time enough. But your real focus area should be this. Okay, still something can go wrong, but you see the amount which will get substantially reduced when 2 checks will fall. I hope students you have understood this picture. That's why the audit risk, the risk of wrong opinion, is a mathematical equation of inherent risk, control risk, detection risk. Inherent risk is something coming from the nature on which nobody has got any control at all. The only thing you can address the inherent risk is by changing your exposure. Like stock market has got systematic risk. Can you do anything? Yes. How? Take your all the money from the stock market, invest in the bond. But the bond market itself has got inherent risk. See, that's why student risk is always inherent at every aspects of our life. The moment we come to this earth, we are facing. Till we die, we have got risk, and we don't know what after death or what before death, whatever. Now, once you face the risk, can you avoid this risk? Yes. How? By not taking exposure, we can avoid the risk. But by avoiding the risk, we will avoid the reward also, because risk and rewards are the two sides of the same coin. So if I can't avoid the risk, what I can do? I can delay the happening. See, this is what exactly do. From the day we are born with the risk of death. Can we stop? Can we prevent the death? Absolutely no. Then what we are doing? Then why we are crossing the road by looking this side, that side? When we are climbing the stairs, we are holding. Why we are all this doing? We are doing it because we are trying only to delay that. But still, despite you have done, things could have gone wrong. That's why we have to accept that reality first. Things you have extremely prepared still could have gone wrong. Because that I told you always that there is an element of luck factor and uncertainty. We have to accept it. Now, this two combination means we cannot separate. See, inherent risk is very difficult to assess. That's why we call them together as risk of material misstatement. Because who decided to get into this exposure? Management. So it becomes their responsibility to establish the controls, right? That's why we give the responsibility of IR and the CR both to the management only. So ROMM is something which can be controlled by the management, not by the auditor. Because this ROMM came from your very exposure into that business activity. You only made a decision to get into that. It was your objective to go there. Okay. So because of which you have incurred a risk and you have to establish a control. Now, my detection risk is secondary. So now what makes sense to me? As an auditor, if I find the controls are good, I have to do test of controls and reduce my substantive procedures. If controls are not good, I have to increase my substantive procedures. Followed, no student? Like see, for example, today I showed you one attendance related one picture. Some people are in red color, some people are in green color. Did I call anybody from the green color? No. Then whom I called? I called all the people who are in the red. I spoke to them. I wish they will soon come into yellow, and from there they will come into green. Because see, this is called a risk based. Here what you do, you focus only on the risky people. Then you figure out, okay, evaluation. Again, we found out the estimation gap. Like how much they expect, how much is the reality. Slowly we have to fine tune now. We have to make them, okay, we have to address that risk is addressed. This is what an auditor should be doing. Okay, because auditor is not an enemy of the management, because the traditional perception is auditor and enemy management are enemies. No, auditor is a business partner. He can help. Okay, they require a coordination between the both. So I hope you are clear, students, about this particular picture. Yes. So now, what is that component? The components of audit risk are defined into three. So it is, audit risk is nothing but inherent risk, control risk, detection risk. Now again, let me go back to the previous example, students. Okay, where I told you that you take the, what is that called, umbrella in the rainy season. See, it works like this. In umbrella, okay, first of all, why we are multiplying this? When we say component should have been added, no? Why we are multiplying the components? What is the fun there? What is the reason? You need to know every logic of what we are doing, why we are doing. For this, no, you have to go back to something called Wagner rule in statistics. Wagner. So he is a statistician, and he said something, one very interesting observation. He said when there are two independent but interdependent things which has got independent probabilities, percentage of its occurrence, like your IR, it doesn't listen to anyone. CR, you may have control, you may not have control. It is, IR is independent, CR is independent, DR is independent. Please understand, all the three components are independent, but they are interdependent, interrelated. Please understand, they are not that they are totally independent and interdependent. What is that called? They are not unrelated. Now he says that everything has got its own probability of occurrence, like whether it is going to rain or not is probable. Like for example, in rainy season, I can take two scenarios. What is the probability of its occurrence? Okay, let me go back here. I'll put it like this. AR is equal to IR into CR into DR. Now in rainy season, what is the probability that it can occur? Rain, I say 80%. In non-rainy season, what is the probability that it will rain? I can say 20%. Now let me, this is situation 1, situation 2. So in the rainy season, will you take umbrella? Yes. What is the chances that, okay, out of 10 instances, how many instances you must have taken umbrella? Sir, 8 instances I would have taken. Whether it rains or not, I don't know, but in rainy season, umbrella is always there with me. So 80% you would have taken. What, in 10 instances, how many instances you would have not taken umbrella? Sir, why I should take? Okay, maybe one day I might have taken. That means only 10% chances I would have taken umbrella. Now, let me calculate ROMM, students. Please understand, it works like this. This is independent, but they are interdependent. Now, Wagner said, if you want to find out a combined probability, what is that I want to find out? What is the probability that you will get wet? That means your water is poured on your head. What is the probability? Okay. When the probability of raining was 80% and your chances of taking umbrella is 80%, if I want to find out what is the probability that you will get wet, he said the combined probability is found out by multiplication and not addition, because we are multiplying two probabilities. This is what you find in AFM, in capital budgeting chapter. Is it not, you are doing a scenario analysis and all? You see, next year it in derivative that this price could be this could be this. So what is that you will say when you have got multiple probabilities? Are you not multiplying multiple probabilities with the scenarios? Exactly. You see, so many applications. Okay. So now what is the chances? 80%, 0.8 into 0.8. You see, you have got a 60. Okay. 80% chances that you would have taken, and what is the chances you would not have taken, because we are talking risk, no? 20%. So 80% of 20%, you see, students, your chances of not taking umbrella That means you are getting wet is only 16%, which is a low probability. Imagine out of 10 instances, 8 instances you don't take umbrella. That means the probability of raining is 80%. But 80% of the time you don't take the umbrella only. That means 64% chances that you could have got wet. And it is more than high. 50% is considered as high. It is more than possible now. That means there is every chances that a person who forgets to take umbrella 8 out of 10 instances would have got wet so many times. That means if I have to ask, show 2 students and I'll ask you which students will get fever, I will pinpoint and say this person is getting high chances of getting fever. There are so many other components also. Have you understood why we are multiplying? Now this risk is made more difficult by the auditor. Now auditor also comes with the detection. Now auditor has to decide, is 16% fine? No, I have to reduce. How? Give Dabur Chyawanprash. Now you have to perform substantive procedures. So how much is the substantive procedures you will perform? Say I will perform only 90% of the substantive procedures. So what is the chances that you would not have detected? Only 10%. Now when I multiply with the 10%, the chances of you would not have detected, because you have been very keen and particular to verify. So 90% of the substantive procedures you did. See, Baba, the risk came to only 1.6%. No, that means it is remote. That means you are really absolutely very close to absolute surety that there is no misstatement here. You can start predicting future. So this is how the concept of risk of misstatement is. It works. I hope it's clear, friends. A very nice concept where we work with the probabilities. Always we figure out what is the chances of occurrence, how much control would I have given, and how much is the, see, if you 80% you take umbrella, 20% is your control risk. If 80% is the chance of occurrence, 20 is no chance of not occurrence. If you perform only 10% substantive procedure, 90% you don't come to organize audit place only. But still 90% of 16% is how much? 16 into 0.9, still 14.4. Okay, that means you are not reduced substantially. So make it 80-10. Okay, so like this it goes. I hope students you have figured it out. You understood. Very fantastic concept. Okay, so now we will go into one by one, because institute has given this concept. You see, first one, calculate M with the percentage they have given. For this you need to understand the concepts. What is an inherent risk? Inherent risk is the susceptibility of an assertion to the misstatement. Susceptibility means I can say exposure of an assertion. Yeah, thank you. Thank you very much, friends. Feels very good. Huh? Yeah, I know, because these things you will not find anywhere. Whatever I'm explaining to you, and if you ask me who told me, nobody told me. It all came to me from inside, because that is the level of effort I've put in the past 8 years on this subject. Yes, thank you very much for your feedback. Yeah, let us see what is susceptibility. It is an exposure of an assertion. What is an assertion? Assertion means okay, for time being, let us identify as an item. I will explain you what is assertion as we go further. That means one item is exposed to a misstatement. What is misstatement? Mistake. What is mistake? Difference between expectation and reality. So one item is inherently exposed to this mistake, that this gap is very high, which could be material. That means material misstatement. That means this gap is so big that it's going to influence somebody's decision, assuming there are no controls. Let us go with the very basic assumption that there is some risk and that risk can eat me. Follow out, no students? So in ICA examination, let us not go with that underestimation. Let us estimate our ICA very clearly. Simply we will not get into anybody's thing. And I will tell you one very fantastic and interesting thing. We proceed further. Then you will come to know what is the reality, how we need to address it. Okay. So I hope you are clear. Inherent risk is the very inherent exposure of an item. We can understand it like this, to a misstatement, assuming there are no internal controls. Now, inherent risk is associated at both statement level and assertion level. Okay. What is statement level? Overall level. What is assertion level? Item level. For example, when you talk about technological changes, particular product become obsolete, causing inventory to be overstated. Now, this is overall level or assertion level? This is an assertion level because I can pinpoint. Because of this technology change, equity is not getting misstated there. Your fixed assets are not getting misstated, but your that particular inventory is getting misstated. So I can pinpoint and say. Now, there are business and other risks that arise from the entity's objective, nature of operations, industry and regulatory requirements. That's why you need to understand industry, regulation, etc. The risk of misstatement vary based on the nature of the account balance or class of transaction. Now, what are the business risks that is of particular concern to the auditor? When you talk about risk, we are talking business risks, or another name is inherent risk. Now, complex calculations which could be misstated. Now, what going to happen, students, if the complex calculations are going to be misstated? What is the business risk? Like, for example, you are giving one quotation to somebody, like you are the building contractor. Now, you need to have single price contract for which you have to quote one price. Now, the customer has given their requirement. For me, it should be like this, the door should be like this, the ceiling should be like this. Now, you have to give one quotation. Followed, no? Now, the requirements are so complex. Imagine one small Excel error happens, and instead of giving quote of say 40 crore for this building, you have given a quote of, because this is your cost of production plus profit. Okay, let us assume your cost of production itself is 40. So minimum 40 you should have quoted if you wanted to break even. Because of one Excel error, you underestimated and quoted 20 crore. Now tell me, students, is this complex calculation has made this contract an onerous contract? See, this is a very inherent risk now in your calculation. This would not have happened if the calculation would not have been complex. So this becomes very important to the auditor now, because the moment onerous contract comes into picture, are you not supposed to make provisions as per Ind AS 37? You have to make. That's why every cash risk will have a corresponding accounting risk, which is that you need to identify. High value inventory, it could have been susceptible to fraud. Somebody could have stolen it, or impairment could have been happened. Accounting estimates that are subject to significant measurement uncertainty. 540 already you digested. You know now. Estimates how the management can play, what could have happened. Lack of sufficient working capital. So when you don't have a sufficient working capital today, no, after IBC has come, if you are not able to pay even rupees 1 crore, 180 days, no, your company would have got closed. Some creditor would have filed a complaint with this bankruptcy court. So you have made some choices where your short-term funds have been invested in the long-term projects. Baba, be ready to face going concern, bankruptcy. And why auditor is concerned? Auditor is concerned because of SA 570 going concern. See, every cash risk has got an accounting implication. Huh? Declining or volatile industry with business failures. Now, because of this failure, no, you want to hide that business failure. You may do material misstatements, fraudulent reporting. Technological developments can make products obsolete and you may still continue value at cost. So these are all the risks an auditor is concerned. Which risk? You can call it as a business risk or you can call it as an inherent risk. So primarily they didn't tell, we will call it as a business risk. These are all the business risks and we can call it also inherent risk because they are very inherent with the business. And let us assume we are not given any controls. The moment business risk comes into picture, now first question, who is facing that business risk? Management, because their very survival is threatened by this business risk. So that's why they have to understand, see, look, what is the risk I am facing? So what is the only way they can establish is by establishing the system of internal control. And see, students, if you are interested, there is one more very fantastic concept in physics. You need to be aware about this, sir. Like why this concept of inherent risk, control risk and all we are talking. See, there is one law in physics called the second law of thermodynamics. See what this law says, very interesting law. It says that the time is something which moves in one direction which cannot be reversed. We know that. Can you stop time? Impossible. And as the time passes, the theory says everything will be into kiosk. So as time passes, the state is not like this. everything is going to decay. It's going to fall down. Please understand the second law of thermodynamics, what it says. As the time passes, everything is destined to go wrong. Because if everything is destined to go up, everybody is going to become successful as the time passes without doing anything. What is the fun in life, students? Tell me. So all of us are destined towards what? Every single living beings are destined towards decay. That's why as we age, our bodies will decay. See, everything, these are all, this very natural phenomena somebody figured out. I can give one more example. Like you have got a room, you have got a study table. Is it clean? Yes. You go after 1 month and see, is it clean? No. You see your room. In day one, it was very clean. After 1 month, it has got distorted. Because this is its very natural state. You say, sir, what we can do? Can we do anything? Because this law, this is the very inherent aspect of it. Inherent aspect of everything is decay. Now, one question you will ask me, sir, can we do anything? No, I don't want to see my room in a kiosk state. I want to be seeing it in a very good state. I don't want myself to do nothing and go into failure. I want to see myself to be successful. You know what physics says? If you want to reverse this, see, this is the natural state. Can you do anything? Yes, you can do anything. What is that? The only way you can do this is by bringing energy. You have to infuse an energy. This is what physics says. And you know, students, what is this energy we are talking? You can call it by different name. This energy is nothing but a discipline or the internal. The only way you can make, that's why no, what do you need to do? If you want to see your room to be clean, what do you need to do? Clean every day, finish. Very simple. That's why when you get an exposure, you have got a business risk, inherent risk. Let us assume no control. What is going to happen? You will find the financial statement useless piece of paper. There will be so many mistakes. Why? If you don't, no controls are there. If government do not come with the rules and regulations, if traffic rules were not there, what would have happened? Anything. So what is the only way to ensure that order? Bring the controls. But there is a, whatever controls you bring, see, for example, you are cleaning every day. What can happen, Baba? Someday somebody can come to your room, they are drinking some tea. The tea can fall on the table. No. See, you are putting fantastic effort, you are cleaning every day, but something can go wrong. That's why every control has got a risk. Are you clear now? So this concept is your risk of mistake. That means organization, by getting into the business activity, they have got a business risk. So since they understand that they have got a risk, they have to establish the internal control, because this is the only way they could have established the controls, address the risk. So entity's internal control system. Now what is control risk? That means despite they have established the control, it's not able to prevent, detect and correct the statement. So what they should do? They should always identify and assess the business risk and other risks and respond by designing internal control. And this concept is called risk assessment process. What they do? They identify the risk. Okay, they assess the risk. Assessment includes your probability and your impact, and they establish internal controls. Yes, next. Entity, okay, so they will establish two types of broad controls called entity level controls and activity level controls. So entity level controls are at a high level, like oversight, performance review, HR, appointing good people. Okay, they are all called overall level, because when you talk about appointing good people, this should happen at every place. Okay, in every aspects. Oversights you should be doing, board oversight. Activity level means specific to that activity. Now, some control risk will always exist. Why? Because we have got inherent limitations of the internal control. A very famous question at the intermediate level. In final also, they have asked the same thing. Okay, I don't know when they are going to ask in the examination. Now, third is the detection risk. This is the risk that the auditor will not be able to detect the misstatement. That means, first of all, ROMM is then component of IR and CR. When the controls are very good, okay, ROMM will be low. then auditor need not detect, need not do anything. But when the problem comes, when the risk is very high, auditor should have put more efforts. Auditor also didn't do anything. So detection risk is also very high. Ultimately, this is going to impact the audit risk. So this is the risk that auditor will not detect. Now one question, Baba sir, auditor is such an expert in accounting. He is the Vidwan in India. Other than chartered accountants, nobody can master accounts because this is our core propriety. How come auditor is not in a position to detect? Now there are two primary reasons why there is a detection risk existing. One, auditor performs the audit on sample basis. Anyhow, those concepts will get, because of the technological changes, you will end up doing 100% audit. Second, there is something called a non-sampling risk. Okay, this is what we will discuss now. So, acceptable level of detection risk bears an inverse relation to the ROMM. That means when the risk of misstatement is very high, your detection risk will be low, has to be low. Otherwise, it makes no sense. Okay, so that my audit risk is always at an acceptable low level. The moment risk is low, your detection risk is very high, because here you don't do anything. Detection risk is like you do something. Okay, it should have one inverse relationship. Now, the auditor identifies the assertions where the ROMM and concentrates your, there are a risk of misstatement, and concentrate the procedures only on those items. So, auditor should consider probability of inappropriate audit procedures. Like for example, I will find out that one student is not attending the class. I will call them. But instead of talking about why you are not attending the class, I am talking something like, okay, did you see the movie? Okay, how was that movie? Did you watch this match? Who is going to win the cup? Hey, Baba, what is this? Why you called? This is called inappropriate procedure. When you have identified the risk response should be according to the risk. No, you are doing something different there. Then the risk will always remain. Or misapplying the appropriate audit procedure. Okay, you apply something in a different way which should not have been done, or you applied properly but the result was totally, you didn't interpret the result properly. So this can be the three causes for your detection risk, which we call as a non-sampling risk. So there are primarily two reasons for detection risk: sampling risk, non-sampling risk. So what is your non-sampling risk? Like you selected inappropriate audit procedure. You should have done external confirmation, but you did what? You did test of controls. You should have done external confirmation and you did the external confirmation, but you gave this work to the internal auditor. This is called a misapplying the appropriate audit procedure. First of all, procedure itself was wrong. Second, procedure was correct, but you wrongly did it. The third situation is procedure was correct, you perfectly did, but you misinterpreted. There was a deviation, you didn't investigate. This is called misinterpretation of the results. So this will result into non-sampling risk. So ultimately, interrelationships of audit components risk will be like this. So you will have a business risk, and business fraud and other factors pose the risk to the financial reporting. And what is the level of inherent risk? That's why you see, students, if I have to map this, it has gone low, moderate, high. 100% is our evaluation. That means this is the risk an organization is facing. So every risk will have a category. Either it is a low risk, moderate risk, or a high risk. For example, in audit, time management in the examination. Is it a low level risk or a high level risk? We say time management is low. But if I take an FR paper, time management is high risk or low risk, or sir, it is a very high risk. Followed, no? Similarly, every risk will have a category. So now this is the risk. What entity will do? Entity will establish entity level and cover entity level and covered IT controls. Okay, they have used a different terminology. Entity controls and your process level controls they have established only up to moderate level risk. Like what all the entity level, like strategic governance, cultures, values, simply they didn't do. Have you seen this? What is this high level entity level control? See, something at a very high level. Like for example, I will put a board, beware of dog. I will put a board, no unauthorized entry. See, this is more like a culture, value. You tell me, students, have you ever, single time, when you see no unauthorized admission, you see this board, have you ever entered that room? You never entered. Now, do they really have a better control? No, simple. Like this type of controls management can make a choice, because see, every control cost. No, they could have locked it, they could have had a biometric, but it is going to cost them. They figure out something like this, or they can have a business process related control, proper, like maker, checker, biometric, everything. So these controls they have established up to here. So a organization has done moderate risk and address high level risk. They have addressed through entity level controls and process level controls. Now for this risk, no, there is no control only. So this is called entity's risk tolerance or risk appetite. This much risk they are ready to take. Followed, no? Like, are you expecting 100% in my mock test? You say, sir, if I get 70 marks, it is fine. That means 30 mark is your risk appetite. You are ready to take that risk in the final exams also. Because you say, sir, my materiality is only 50%. If 70%, if I score in the mock test, it is well and good. No, why you expect me to score 100%? So I say 30% is your risk appetite, for example. Now, this is the combined risk of the control, because see, when you have established control, will it work properly? May not be. So there's a combined risk is this. Now, auditor will perform the procedures. How? Since up to here, you have got controls, like working in the organization. Up to here, you have got a controls. So you will perform test of controls. But for this portion, there is no control only. So auditor may decide to do substantive procedure. And up to here, if there is a very high risk, auditor may decide not to do test of control, but to do substantive procedure. Like for example, let's say 540. You have got high estimation uncertainty, significant risk, or you have got a fraud risk. So you may verify the controls of the organization, but in addition, you may decide to do substantive procedure independently. Moderate risk, you may decide to do the test of controls. So because of this, you brought your, this is that portion which is you are not never testing only, but you see students, because of the 3 people effort, okay, not 3 people, because of 2 people effort, something could have gone extremely wrong, 100%. Somebody has put a majority of efforts and brought it substantially down, and somebody will put something more effort. Ultimately, the risk is reduced to an acceptable low level. And this is your audit risk now. You may end up expressing a wrong opinion, but it's not material. Very fantastic concept. So mathematically, you can express it in the form of audit risk is equal to IR into CR into TR. Now, audit risk has got 2 components called risk of misstatement, because these 2 combinations we call ROMM. What is ROMM? Every cash risk resulting into accounting risk. Okay. What is the cash risk? We call business risk. Like for example, bank may not give you loan. So you don't have a working capital loan. Arey baba, it is a cash risk. You are cash trapped. Now, what is the accounting implication of it? You may have to follow going concern basis of accounting, or non-going concern accounting, liquidation accounting. This is the accounting implication of it. Followed, no? So this concept, okay, this is an ROMM. So who is concerned with the cash? Management. Who is concerned with the accounting? Audit. Now, the relationship can be defined as audit risk is equal to risk of misstatement. So risk of misstatement is anticipated risk that the material mistake may exist in the financial statement. Why? Because of its inherent risk and before the start of audit only. So you go with the assumption that something inherent risks were there, which the management is not able to prevent it after putting the control. So it has got 2 components called control risk and inherent risk. Detection risk is the risk which remained undetected. It should be noted that the combined level of inherent risk and control risk is inversely related with the detection risk, and audit materiality is also inversely related with the audit risk. Okay, what is that they are trying to tell? That means your ROMM into DR are inversely related, okay, interrelated. Like for example, students, I can give you one more example. Now, when you sense the risk is very low everywhere, you don't take care. Like for example, you go to one restaurant. In that restaurant, you really don't know the way they prepare the food. But what happened? No, you trust that they must be preparing well. So since you are trusting them that they are preparing well, and you never heard about any incident of food poison and all, your perception of risk of misstatement is low. That's why you don't test anything, you straight away go and eat. By doing this, your detection risk will increase. Something could have gone wrong. Have you ever tested it? Have you ever tested it? You could have been the victim of food poison. Ulta, you have heard about incidents of food poison in that organization. So ROMM is very high. Now you tell me, students, if you have already heard about 3 incidents about that restaurant, but of no choice you had to go to that restaurant. On that day, don't you tell me, are you very serious and very careful before you eat? First you taste something, then you wait for something for the reaction, or you will ask some questions, you go to the kitchen. See, these are all the additional activities you perform because your sense of risk is very high. So automatically your substantive procedure will fall down. Why? Because detection risk has got inverse relationship with the substantive procedures. The more substantive procedures you perform, less is the detection risk. More substantive procedures you perform when the ROMM is very high. See, these are all extra things. No, you are testing once, you are testing on your friends, you will send to lab. These are not required. If the risk is very low, you will perform like substantive procedure. Since you perform less substantive procedure, detection risks are going to increase. I hope it's clear. Yes. So the audit risk has got 2 key elements, ROMM and DR. The overall objective is to assess and limit the detection risk. Auditor risk is to assess the risk of misstatement. You have to make an assessment, because that's what I told you in one of the question. They asked you how auditor can control the risk of misstatement. Tell me, Baba, how auditor can control? Auditor can only measure that. He cannot control it. Okay. So we may have to interpret that they are telling about the measurement only. Now let us see some of the examination questions, friends, Q&As, which could be there. Now, the objective of audit is to reduce the audit risk to an acceptable low level. Always you need to take audit risks to an acceptable low level. Say AR should be 10%. What is the meaning of 10%? That means after I have done an audit, the risk that wrong opinion I could have expressed is very low. How much? Only 10%. How? Because in an environment, let us assume if the management is not good enough, so your ROMM could be very high. Then what you end up doing? You do so much of test. So your detection risk is more. So ultimately, your ROMM becomes, your audit risk becomes, say, for example, if your ROMM is 100%, that anything could have gone wrong. So what you would have done? You would have put 90% effort. Because of the 90% effort, detection risk becomes only 10%. So your audit risk becomes 10%. So always, this is what they say, you have to limit. See, please read the language here. What is the objective of the auditor? Is to make an assessment of the ROMM and reduce the detection risk. That means detection risk is always the balancing figure, because we have to limit the detection risk. How? By making an assessment of the audit risk, because audit risk is not within your control. The standard only told that you have to maintain an audit risk to an acceptable low level. You cannot take audit risk like a mad 90% risk. Like when you invest in any shares of the company, you tell me, students, how much risk will you assume? You will take a reasonable risk. No, you will invest in blue chip company only, but despite knowing that it could have been wrong, but that risk is very low. You don't invest in an unknown company which could have been died tomorrow only. That is a very high risk. So in personal life, you may take, like me, in share market, now I invested in company which I even don't know only who it is, what it is. That 2 lakhs of rupees I invested. It's madness, leave it. But you cannot take such madness in the audit, no, because you are playing with somebody's money, somebody's trust. That's why our standard says you have to always take audit risk to an acceptable low level. So in an environment, if you want to maintain ROMM, you have to limit your detection risk as a balancing figure. This may be achieved by performing procedures that respond to the assessed risk at the financial statement session level. Okay. So let us see some of the questions, friends. I think, yeah, we will read this and then we will go on. Number of embedded insertions are included in the, now next is a section. We will see this later. Let us go to test your knowledge 7. Very beautiful question. Till now they have not asked. I don't know when they are going to ask. They said compute the overall audit risk. So they are asking you to calculate the audit risk. If looking at the nature of the business, there are chances that by default 40% of the services provided would be defaulted. So what is your inherent risk? 40%. That means out of 100 bills, 60 bills only will be proper. Out of 40, no, somebody will play. Because the nature itself is like that. Like for example, you must have gone to some hilly area, okay, some trekking or some ship boating and all. Have you seen students like, okay, Dudh have you seen there, like for example, they don't have a QR code, they deal have only cash. Now this particular environment gives high scope for manipulation. This is what they are telling, that the nature of the business is such that the 40% of the bills provided, by default they have got a chance of defalcation. That means my inherent risk is 40%. Now what they said, look sir, we also know that the 40% is a very high chance. 40% are subject to misappropriation is a very high. What management said, we have established the internal controls. This can prevent defalcation up to 75%. That means, what is their level of controls? 75%. That means, what is the risk that they will not be able to detect? 25%. So, out of 100%, if the 40% are the chances which could have gone, 75% they have put the controls. They could have put 100% control. Anyhow, that's why I have told, no, they have got some concept of risk appetite also. You have already seen here. They will not put 100% control. They have got some risk appetite. Okay. Now, what is your ROMM? ROMM is calculated by multiplying IR into CR. IR is 0.4 into CR is 0.25. That means 10% is your ROMM. Now, at this part, the auditor assesses. Now, one question comes. Should I take, what is my audit risk? At this part, the auditor assesses the procedure he could apply in remaining time. So, what is that he can apply? Substantive procedures. Audit gives him satisfaction level, that means confidence level of detection of fraud error to the extent of 60%. That means his detection confidence is 60%. That means he has got some time, he is going to perform something. By performing it, how much confidence he is going to get? 60%. That means he is not going to perform 100% of the audit. He will take some samples and all. So that sampling and his mistakes and all those things can give him 60%. So what is the risk that it would not have happened, he would not have been detected something? It is only 40%. Now when I multiply ROMM 10% with the 40%, generally this should have been the balancing figure. Now what is your audit risk? Audit risk happens to be 4%. Now one question comes, is this 4% acceptable low level? Yes sir, very much acceptable low level. Oh, that means if that's why it's connected with the materiality. Now are the investors expecting 4%? That's why we take the benchmark, multiplied. I told you 1%, no? If that multiplied percentage happens to be 10%, which is our materiality, that means this 4% is very low. So what I can end up doing, I can reduce my substantive procedures. Because ROMM I am not going to touch. So what is that? I may end up not doing anything. 100% detection risk I will take. Why? Because if, see, risk is 40% by default. Management has prevented 75%. Means how much, if you don't do any work, how much is your audit risk now? Which is equal to your ROMM only. So 10%. See, this is how you play. You may decide how much substantive efforts to put. Ultimately, students, in an audit risk, you decide how much effort I should be putting to see that there is no material mistake. What is the question here? How many questions are there? This is how I explained to you. Let us look at the question. There are two questions. One, compute the overall audit risk, analyze the risk of misstatement, and find out overall audit risk. You have to analyze the components. I told you, when you say analyze, it has got pieces. So now you talk about the what is SA 200 audit risk is the risk that you will explain what is the audit risk. Then you have to talk about the components, because they said analyze. You say what is the inherent risk. You explain in the given case what it is, 40%. What is control risk? You explain that control is not able to detect. How much extent control you have put? 75%. So what is your control risk? 25%. Now, what is the amount of the risk of misstatement inherent into CR? 14 to 25, 10%. Now, what is the detection risk? Because you get only 60% assurance. That means 40% you will not be able to detect. And when you multiply 10% with 40%, you get 4%. Yes, we can say it is at a low level. So he will try to do more test of controls and less of substantive procedure. I hope you are clear, student. Very nice question they have given. Yes, I think very similar question they have asked here. Compute, analyze the risk of misstatement. Only percentage they have changed. This time it comes to 3%. Test your understanding too. You have recently been appointed as an auditor of NGO in the field of upholding democracy for the first time. Okay, it's an NGO. Last year they were unaudited and its activities are limited in a small scale. Now your opening balance, comparative, all these questions will come into picture. Because when you read this unaudited, no, your mind will go there, your 710 and all. However, it is only the current year that NGO received a substantial donation risk from the foreign funds. That means FCR, a Foreign Currency Contribution Act, EMA, all those things are applicable. The said NGO is also doing crowdfunding donation. That means anonymous donations you may be receiving. Government has now legislative power to cancel FCR certificate of this NGO. That means NOCLAR is also applicable. That means if they found to be violating any of the provisions of Foreign Contribution Regulation Act, your license can get cancelled. SA 250, you don't know what they are going to ask. Every component is involved. Since it's working in the field which encompasses political and social fields, accusations and counter accusations are flying thick and fast. So many people are giving rumors, okay, this fund is there, okay, they are diverting the fund and all. What factors would you consider in assessing of the audit risk? Okay, a very nice question. You can mark it as a priority question. They will ask you in the exam. For assessing the audit risk, auditor should consider the component of the risk. How do you assess the audit risk? You have to look at the component. Did you identify any inherent risks here? Yes. What is that? First of all, it is working in a political cum social field, which is inherently risk. Is connected with the politics. So some political donations and come through this NGO. Crowdfunding donation they are doing. Anonymous donations are happening now in the crowdfunding. On top of it, they are receiving foreign funds. Now, credibility of the person behind the NGO is very important, because if the rumors are coming, then tomorrow nobody will contribute. Tomorrow any crowdfunding happens, nobody will pay. If the rumors come that there is some, and such rumors are spreading now. Some they said no here. They said some flying thick and fast accusations. See, these are all the inherent risks, and non-compliance can result into your cancellation of this. So you have identified 4 or 5 inherent risks. Now, what is that control risks you see? Since you receive substantial donations in the current year, last year your scale was small. Now, what we feel that formal controls may not be in place. See, students, if you slowly grow, then chances are very high that you would have been very powerful and strong internally. Now, sudden jump happens, no? See, this is how it happens. Huh? All of a sudden, when we get success, no, this is real story I'm telling, because we always look success trends. We don't see the other face of the success, because see, success brings one immense pressure to retain it. That's why I never I wish God give me that power to retain the success, whatever I get, because success brings immense pressure, which we not see that. It brings so much responsibility on us. So sudden success, no, it will not justify. That's why this is what you see. Last year, the small amount of fund was received, very big amount received. They may not know what to do. I can give you example of Rajesh Khanna. You know Rajesh Khanna? The Hindi movie, never ever seen a superstar. The word superstar came after Rajesh Khanna. In 1968 to say 73, 5 years, nobody would have given in Hindi movie back-to-back blockbusters, which Rajesh Khanna gave. And the biggest problem with him, since all of a sudden it happened, even he did not know how to control it, how to utilize it, how to channel it. Later superstars like Shah Rukh Khan, okay, Amitabh Bachchan, whoever later superstars came, no, they already had an example to refer someone. Okay, this happened to him. This happened. This I should not be doing. But when something first happens, no, you get so much fun. Like, I can give one more example. Somebody earned a lottery, get 500 crore. Literally, they didn't know what to do with it. Somebody got murdered and they lost everything, and again back to the road. This is control problem. This is what you need to identify. This could have happened with this organization also, and there are non-compliance is very high, and we are not sure what type of controls they have put. So control risk is also very high. Now, since you are the auditor of NGO has happened for the first time, you are also first time, you also lack the understanding. So your detection risk is also high. That means, students, this audit is a very risky audit for you this year. Be careful. So don't consider this audit like any other audit. You have to pay more attention this year. Followed, no? Okay. So I can give another analogy to you. Okay, I have been teaching students from past 8 years. Okay, underworld don comes to me and says, look, my daughter or son, please teach them. Now, can you tell me, students, can I consider this particular boy or girl as a normal student? Baba, tomorrow something in examination, something happens to me. This is an underworld don. Okay, for him, killing humans are like a killing ant. It's a very risk, no? Then what should I do? Should I treat them as a normal student? No. Substantial focus should be on that student now. Reward is also very high. That is different story. Now I need to make a choice. Am I in a position? Should I accept that audit? Followed, no? These are the choices you are supposed to. So this is how you need to analyze, friends. So understood, no? This is not an easy question. That's why I suggest please mark it as a priority 1 question, because you have to at least go through 1 day before the exam. Next, number of embedded assertions are included in the management's representation. Okay, we have to give an heading called assertions. So before I explain to you what is assertion, I want to give you one very simple example to make you understand what is an assertion. Because next we are going to talk about different types of assertion. Okay, I'll ask you one very simple and very basic question, students, which you must have come across in your day-to-day life also. Now, imagine this is you. This is your friend. And this is your uncle. And this is uncle's daughter. Hello? Now, have you ever experienced this? That one day, this your friend's proposal goes to your uncle's daughter. Well, talking and all, because they have to, because SA 220 says what? In client acceptance, and you need to obtain vital information. And one of the very first vital information is the integrity. Then your competence and ethical requirement. And how to figure out the integrity? What are the factors? We already seen business reputation, inquiry with the known people. Are they in money laundering? And somewhere, because how to know about the business reputation now? Now they understand that you are the friend of this particular person now. They understand. Will they not call you, students? And they will ask you, how is the boy? Have you never witnessed it? Now what is your answer? You say, boy is good. See, what exactly you mean to say good? What exactly you mean to say good? Boy is good. Okay, fine. Which aspect of boy you said good? Did you say his character is good, earning is good, or his social behavior is good, or does he not having any affairs with someone? In that aspect it is good, or his family is good, or his way of talking is good, or is he helping? Which characteristic did you say good? Okay, I can ask one more thing. I can tell he drinks. Now Is it a good or bad? Now this is a concept of a materiality. If this family comes from a background where drinking is prohibited, materiality level, then that is a bad. You have to communicate. What if your father-in-law, his mom, this uncle also drinks? Okay, nice company. No, for them it is a common. They say, okay, Baba, that is common, normal. So materiality definition, so many factors you have to consider. But my point here is, when you talk, tell whether the boy is good, which character did you suggest? Should you not get that idea well in advance? Because tomorrow, if they find that this person has got some problems, first question they will ask you only, right? So whenever you say good, see, what is that thing you always have in your mind? See, this is implied. You will never ask, uncle, which aspect you asked me to certify? You never ask this. When you talk about good, you make one judgment. The judgment includes character, family background, their earning, their whatever appearances. So these are all the four elements. Appearance you do not consider because that is none of your business. Primarily this, because appearance is a feature, that is something visible. What is that you are looking? Characteristics which is inbuilt, which is not visible from the outset. So this you certify, uncle, in this respect they are good, which you will not explicitly tell, but implicitly you are certifying this. Now, what if your uncle specifically asks you, does he has got any health problem? Can you certify? The answer is yes. What do you need to do? Tell uncle, since we are relatives, I can give only this certification because this doesn't require any effort. It's a reasonable assurance I can give you. But if you want to know whether this boy has got any health problems, is he having any affair and all, then you have to transfer some 50,000 rupees to my account, additional money. Why? Because I am going to hire some people who are going to investigate now. I will put some people behind him and they will get that investigation report. They will follow that person. They will go to the hospital. They will check everything. And that assurance I can give you. And that level of assurance is an absolute assurance. Understood, no? So when you are telling good, please understand there are only few assertions you certify, not all the assertions. But if the investors are looking for more assertions, then we will show our fingers to the internal auditors and go and ask them. Like if we are, okay, now one question comes when I am certifying the financial statement is true and fair. This is my financial statement item, which is true and fair. Which assertions I am certifying? Because what happens, students, if any one of the assertion will go for a toss, no, item will go for a toss. Agree with me? Like his family background is not good. Right? Nobody will care whether the boy is good or bad. No, I'm just telling old. Don't generalize. I'm just telling you. Or his character is good. Gone. Your every other factors can be good. Everything is gone. So what is that assertion or the characteristic for the financial statement items which the auditor is certifying? That's what we are going to see here. So when for this, no, we have got three groups of assertions. One is called a class of transaction. In a layman language, it is called a P&L. Another is called account balance. In layman language, it is called a balance sheet. And the third is called a presentation and disclosure, which we call notes to accounts. Because these are all the primary financial statement items. When auditor has signed all the three, what he is trying to tell? He is telling the transactions, okay, I can pick any one here, are complete. That means nothing is left out now to account. Second, we have followed cutoff procedures because P&L is prepared with that reason only. Accounting cutoff, accounting year. Third, we have followed classification properly done. That means what should have been capitalized has been capitalized, what should not have been capitalized has been charged to P&L. Fourth, the transactions which we have done has occurred. They are not fictitious. And the fifth one, the transactions are measured accurately. There is no calculation mistakes in their calculations. So who told us? SA 315 told us that if an auditor is certifying the financial statement, these are all the 5 assertions auditor is certifying for the P&L. That's why, students, in audit report you always say we have done audit as per standards on auditing in India, SA. The moment you told, that means you are compliant with SA 315. And SA315 has only told only 5 assertions. Now, what if the investor wants to know whether propriety assertion, that means whether the expenditure incurred was should have been incurred or not should have been incurred? And Baba, then we say that is not our propriety audit, is not our audit. Our audit is only 5 assertion. You want propriety audit? We want to, do you want me to do propriety audit? Yes, definitely we will do the proprietary audit, which is the 6th assertion, whether this should have been incurred, whether it is economical. Do you want us to do economy effectiveness audit? That also we will do it, but different assignment. For me, give me extra money. I hope, students, the concept of assertion is very clear. That's why your audit is it will expand. Now, again, I can give back again analogy of your same story. When you say CA final is made up of different items, FR, audit, AFM. When you talk about audit, your risks are at a different level. I told you, memory, time management, articulation, and your one more thing called applications. So it will expand. So finally, if I say, yes, Baba, you are ready, that means my certification is only for these 4 assertions. Somewhere another new assertion you bring into picture and ask me, no, Baba, sorry, because I'm not an investigator. I'm a reasonable. This is the reasonable assurance we can give. Followed, no? So my test should have been included all these 4 areas. That's why generally who will have this? One mock test will have all these 4 areas. That's why, student, traditionally we have been doing mock tests, because one test include your evidence, but it's very difficult to measure actually. That's the big problem. Anyhow, I hope you are clear about the assertion here. So number of assertions will be embedded. How many number? That's what SA315 says. In the management's representations about the financial statement. They related to the recognition, measurement, and presentation and disclosures. Now, management may assert that the sales balance are complete, occurred, accurate, cut off. So SA315 talks about the assessing risk of misstatement, categorizes the types of assertions into following ways. They say that there are assertions related to class of transactions. So you pick up anything, like you can pick up inventory, you can pick class of transaction, no? Purchases, payroll expenses, maintenance expenses. So there are 5. When you sign the P&L, there are 5 characteristics of that expense you certified that expense occurred, but that means it is not a fake. It is complete. That means what they have not recorded, no, there is nothing like that. All the provisions, if the bill has not come, they have made a provisions. They are accurate value. That means there is no overstatement or understatement. Last year bill they have not recorded, and what they have done, they are properly classified. If it is a payroll expense, okay, which should have been gone to asset construction and cost of the asset, they have done that accordingly as per Ind 300, Ind 16. So these are all the 5 assertions you are certifying. When it comes to the balance sheet, see, assertions will change because the nature of the items in the balance sheets are different from P&L items. So for a balance sheet, you tell whether it is existing on the balance sheet date. How do you find out? By doing physical verification. Now, what if the existing? Is it your asset or obligation? Third, is it complete? Is there anything which is not yet recorded in the balance sheet? And whatever value you had recorded, that is proper. Like allocations you have done properly between your overhead allocations and all, wherever required you have done it. Yes. And then for a presentation and disclosure, anyhow, at the intermediate level, you have come across this. We have got 4 assertions. Occurrence, that means your all disclosures have really occurred. You are not, see, very important trend. Like pharma company can give on disclosures that we have found out a medicine for cancer. Arre Baba, next day the share price is going to shoot up if this type of disclosures are there. Is it really occurred? Have you really found out? No. Then why you are giving? It is a fake, no? And whatever you are telling, if you are selling your contingent asset, is your right. You are not left out anything which your standards or your framework companies have told you to disclose. And your classification is proper and understandability is very clear. That means your way of presentation is very clear and understandable. Because sometimes, no, the management can fool people by making it look very complicated. See, the way you organize, no, see, like our study material. don't you think students ICS intentionally, they could have done very good in the point of paras and all. See, they don't want to, but anyhow, human brain nothing cares. Huh? If you get used to reading the para, you become used to reading para. If you become used to reading point, you become used to reading point. That is the beauty of human brain. How you train, that way it gets trained. And finally, whatever values you are disclosing, it is accurate and proper. Okay, so let us see the illustration number 1. There is your illustration 1. Okay, yeah, one small thing, okay, up and down has happened. Now I have marked it as a priority 1. During the process of extraction of exception reports, auditors noted numerous purchase entries without valid purchase orders. That means orders were not there and you have posted so many entries. Is it fake? Is it unauthorized? We don't know. In terms of percentage, 40% of the purchases were made without orders only, and few orders were validated after purchases. Also, there was no reconciliation between the goods received and goods ordered. Suggest the risk related to which assertion? Okay, what is that they are trying to do? It is the validity of the purchases. Anyhow, students, this they have given in the form of illustration. We have to go by that only. Please understand here. In inter also you will see similar type of questions there. Now, what type of assertion? You can say it is the validity of the purchases, or I can say your occurrence. Because has it really occurred? You can tell that also. Because when somebody numerous purchase entries are there without order, this could be fake purchase entry because orders only not there. So you can also say that it is an occurrence assertion. Now, second question, whether this risk is pervasive or account level. Sorry, I should then show you this. Whenever you identify the risk, because before that, no, I should we should discuss this. Anyhow, we have discussed so many times. You need to classify the risk in 2 levels. One is called overall statement level, and another is the specific assertion level. Now, if the top accountant is not competent, now this is an overall level because any item in the financial statement could have been wrong. But if the cashier is not competent, then the risk of misstatement can occur only in cash, not in other items of the financial statement. If the CFO is not competent, that any of the item of the financial statement could have been wrong. That's called overall risk. The second level risk, which is called identified with a specific assertion. So you can also call it assertion level risk, direction risk. Okay. It can be at the class of transaction, account balance, or disclosure level. This means that for each item, you have to make an assessment of risk as high, moderate, and low. Should be made with the individual assertion. I told you, no, student, one ICA can give one tough paper, any of the account. We cannot say it's the overall level. Okay, now at the account level, item level, like you have got FR, AFM. If I pick FR, it has got assertions, memory, articulation, solving, whatever. You have to make high risk, low risk. Like this, we have to make an analysis. While considering the valuation assertion, the auditor could assess the risk of error in payable as low. However, for inventory, obsolescence is a factor. The valuation risk is very high. That's why we cannot say, students. That's why it's all item to item, it's going to differ. I told you sometime, because for everybody memory is not a problem, because some student can have a photogenic memory, but for someone who is having, best example is Kim Peek. His memory is excellent. 2 books at a time he can read. But since his IQ is very low, his application is not good. Newton, whose memory he doesn't remember anything, but his application is fantastic. So each person has got a different risk, and I was feeling like laughing today. Somebody in the YouTube and all putting one strategy planner, how you need to prepare for November exam, sure not to get so many marks and all. So friends, I really don't find any point there having such strategy, because this is a very generic strategy. You take 4 days to read this, you 10 days to read this, 2 days for doing this revision. That's what you have to figure out. No, you are a business, you understand yourself better. What is easy for you, what is difficult? Don't you think you need to have your own strategy there, your own planner? And who is the best person to design it? You only. So you have to take that decision. You have to do that risk assessment. Okay, following that strategy, somebody's generic plan, no, it can end up with a disaster. Because see, they don't know, because one planner cannot be appointed for everyone. So another example where the risk of misstatement due to completeness in the inventory could be low, but in relation to the sales balance, it could be high. So the difference between assessing the risk at the overall financial statement level and assertion level is given like this. So financial statement level, that means any of the item, inventory, cash, revenue, related party disclosure. So all these are your balance sheet items, all your P&L items, or your notes to accounts items. So any item could have gone wrong. That is the financial statement level. Now inventory, we have got 4 assertions because it is balance sheet item. Class of transactions, we have got 5 assertions. So for every assertions, we need to mark high risk, low risk, high risk, low risk. And then we have to design your audit procedures to address that risk. Okay. Now they asked you, this particular fake purchase, is it an overall risk or an account balance risk? Okay. It is an account level risk, because see, if your purchases are accounted without purchase order, tell me students, is your equity balance, your fixed assets, your security deposit, will it go for a toss? No. So this is called an assertion level risk or account balance risk. You can item level risk. Now, which items are affected? Purchases and only accounts payable. Only 2 things will get affected. Maybe you can add inventory also. Now, what is your audit procedure? So you will select few purchases and check a correspondence with the vendors. You take the list of vendors and check the aging. Have they been paid? Is there any old outstanding vendors? Why? Because if you have posted fake purchases to reduce the taxes, you will not pay them. So always it will remain in the aging. And after 2 years, you say that this vendor is not traceable and you will reverse. Follow? Now that your income may be low. So you will take this as a secret reserve. That's why take the vendor listing and check the aging. Meet the company's purchase officer and obtain the responses of make inquiries like why orders are not made, and you are getting the material, and discuss the summary of issues with the client. This will be your audit procedure. Very nice question, students, they have asked. Okay, maybe one last point we can, I think this is the last. Yeah, then we can wind up the first section. Actually, we are supposed to make notes, but since the concepts are so beautiful, I feel like go on talking about this. Yes. Now, the first part was about risk assessment. Risk assessment is all about your audit risk. Audit risk has got a component, and we have understood that component, and we understood that auditor has to do that risk of misstatement assessment has to happen at the assertion level. Okay, students, very fantastic concept. Frank Knight in 1921, he wrote a book called Risk, Uncertainty and Profit. And for the first time, he came with one idea or a concept called risk versus uncertainty. First time he came. Now, what is risk and what is uncertainty? Both are same? He said no. He said the risk can be something which can be measured. Uncertainty cannot be measured. Like, what is this risk and what is this uncertainty? Now, I can give you an example. Okay, so this maybe probably we'll see tomorrow, students. Today it is very heavy. We'll visit this tomorrow. But this is a very nice concept. So when you talk about the concept of a risk, how it is different from uncertainty? Imagine a bank has given 1,000 loan, and in the past 20 loans has become bad. Now next time before it gives, should it not make one assessment of the risk? Yes. So what is the risk of NPA? So now it says 20 divided by 1,000. That means we have got 2% risk of bad debts. Now, can you calculate this? Yes. That's why we call it risk. Something measurable using probability theory is a risk. This is what he told in 1921. Suddenly it opened the mind of the people. Then they said, if I can calculate the risk, then I should be able to calculate its impact also. What if this risk happens? Please understand, friend. And what is uncertainty? You cannot calculate. Please understand, you cannot calculate. Like, what is the probability that India is going to become number one in 2050? You cannot calculate. It is uncertain. India may become number one, it may not become number one. But can you pinpoint with one percentage and say there is a 20% or 80% chances that India is the number one country in the 2050? You cannot tell. Now you tell me. You are writing CA final exam, no? Are you facing risk or uncertainty? Let us understand. You are not facing uncertainty, students. Please see. Because after this person's concept, your risk management subject came. After this identity, this theory. In 1950s, that modern portfolio theory came. He explained correlation, okay, regression, and your standard deviation. All those concepts got developed with this invention, is this idea. Okay. Now we are facing risk, we are not facing uncertainty, because if it is an uncertainty, you cannot do anything, students. Like when it comes to death, we say uncertainty because we don't know, we cannot measure it. But risk is measurable. Oh, beautiful. If we can measure the risk, we can address the risk also, no? Please understand, friends, this concept. Okay, it's not that it is an uncertainty. Please understand, with the passing CA final exam is not uncertain. Passing examination is risky. So the point here is you have to measure your risk. And some people thought, they went further. They said, if I can measure the risk, can't I measure what if the risk occurs? That is called the impact or consequence. Okay. So finally, how should I do that risk analysis? Okay. I need to see a combined probability of both. Like, what is the chance that risk could occur? 50%. What if it occurs 1 lakh rupees I am going to lose? So what is your probability of loss? 50,000. How? You multiply. So probability is considered as a dimension 1 to do risk analysis. Impact is considered as dimension 2 to do, and you find out a probability of a risk with the multiplication of these two elements. Okay, so I hope it's clear, very interesting. So tomorrow we will see how we can apply these concepts in risk identification. Yes, students, thank you very much. So I hope you enjoyed. I also enjoyed because certain things were totally new to me also. While talking, while preparing only it came. Anyhow, I'm also putting more efforts to measure your risk. Let me see. I told no, this time I am doing it in a bit different way, not as a traditional way, what I have done in the past. I don't know where exactly it is going to take me, but I'm very much confident. And again, I request your cooperation. Please help me to measure you. Let's see how we can proceed. Yes, thank you. So we'll meet tomorrow, students. We'll discuss this concept tomorrow.